This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. Today's topic is private credit in trouble. 3 quick points. So here's the discussion. Just recently, you're seeing some private credit funds find themselves struggling with redemptions and not being able to handle redemptions. You're also seeing some of the private credit loans that are being held being marked down. I'm just going to go through 3 quick points on private credit. And it doesn't mean that the world is falling apart, but there are some cracks in what was an incredibly positive asset class for several years. So first, defaults in private credit are rising after what has been a decade-long boom. Private credit expanded rapidly to about 2 to 3 trillion globally. But higher interest rates and a prolonged interest rates and not being able to exit are putting a lot of pressure on borrowers. In 2025, U.S. private credit default rates hit about 9.2%, a true record for the sector. And it's largely driven by small and mid-market companies struggling with higher floating rate debt costs and higher debt costs. So that's a real big number, 9.2%. That's an incredible number. Second, liquidity and redemption pressures are emerging, as we mentioned a moment ago. Several large funds have limited investor withdrawals or faced large redemption requests. And this also raises lots of questions about the sort of liquidity of the asset class, where the sort of investments are somewhat illiquid and the valuations are fairly non-transparent. This does cause some concern that there could be a contagion effect as investors rush for the exits if they start seeing exits and liquidity cut off. Finally, there's increased concerns again about underwriting and transparency concerns. And this reminds you back of sort of the mortgage crisis where people were writing mortgages for almost anything. Regulators and analysts are increasingly worried that looser lending standards have led to a lot of the private credit growth and that we're going to end up having trouble at some point. Much of the private credit loans aren't marked to market, so it could take a long time for some of the losses to appear and really show through. And in some ways, private credit funds can sort of hide those for some time until they can't. So it's not that private credit is blowing up, but for the first time in some time, we're seeing much bigger challenges and concerns about it than we've seen literally in the last decade, where it's been an asset class that has been on fire. Suddenly, it's not nearly as on fire. Thank you for listening to the Becker Business and the Becker Private Equity Podcast. If you find this helpful, please text me at 773-766-5322. I'd love to hear your thoughts on it. If you're the first person to text Scott Becker after listening to this episode and give me your comments on it, we'll send you a $100 Amazon gift card. Thank you so much for listening to the Becker Business and the Becker Private Equity Podcast.